Let's jump into accounting terminologies for prepayments. Prepayment expense is a current asset in balance sheet. I will give you a brief definition of what is current assets. Current assets are balance sheet accounts that represents value of all assets that can be reasonably expected to be converted into cash within a year. Current assets include cash and cash equivalents, accounts receivable, inventory, marketable securities, prepaid expenses, and other liquid assets that can be readily converted to cash. Now let's jump back to prepayment. A prepaid expense is a type of asset that arises on a balance sheet as a result of business making prepayment of goods and services that to be received in near future. While prepaid expenses are initially recorded as asset, their value is expensed over a time as the benefit is received onto the income statement. Because unlike conventional expenses, the business will receive something of value in the near future. Due to the nature of certain goods and services, there must be prepaid expenses. For example, insurance is a prepaid expense because the purpose of purchasing insurance is to buy a proactive protection in case something unfortunate happens. Clearly, no insurance company would sell insurance that covers occurrence of an unfortunate event after the fact. So insurance expense must be prepaid. Benefits received later. Companies make prepayment for goods or services such as equipment or insurance coverage that provide continual benefits over a time. Goods or services of this nature cannot be expensed immediately or entirely as a cost to revenue on income statement in one single accounting period and must be recorded as assets instead on the balance sheet at the time of their purchase or before being used or consumed. To record prepayment, you have to debit the equipment or insurance policy account and credit cash account, assuming that no credit is used. This effectively increases the amount of prepaid expenses in the balance sheet as an asset account and reduces the cash balance in the balance sheet. Matching principle of accounting. The matching principle of accounting requires expense to be matched with revenues at the time expense makes its contribution to its revenue. In other words, expenses are recognized not necessarily when the related payments are made, but when the benefits from the expense can be tied to the expected revenues. Let's take a different example. A piece of equipment depreciates after being deployed in use. Periodic depreciation cost is recognized as expense for each accounting period when the use of equipment is actually contributing to each period's revenue generation. The approach to matching expense is letting the expense follow the revenue. This will apply same to our prepayment accounting concepts. We will explore more about this matching principle in the next slides.